Well, with that, let's call the meeting to order. It's 5:32 on October 26, 2020. First item on the agenda is roll call. So hopefully everyone's unmuted and they could signify by saying aye if they're here. Kathy Ward.
Aye.
Art Carter.
Aye.
Al Sondag. Okay, Al is not here. Bill Blackwell.
Here.
And I see that Eric and Courtney are here for the city.
Hello.
And also Jenny is here from Chandler. So with that, let's go to the second item, which is the approval of the minutes for the July 27th meeting. You all received that in your package. So do we have any comments or changes regarding the July 27th minutes? You all received that in your package. So do we have any comments or changes regarding the?
I don't have any.
Okay, so I need a motion to approve the minutes as presented.
So moved.
Art, thank you. A second.
I'll second that.
Thank you, Kathy. All in favor, say aye.
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 Thank you. So moved. Or I should say any opposed. I think I saw your lips moving, but any opposed? Okay, so moved. All right, next up is the investment report for the first quarter of fiscal year 2020-21. And I'm going to have Jenny start us off on that, and then I'll pick up for the internally managed portfolio. So Jenny, are you ready? And also Courtney, I think you're going to put the report up as we go through it.
Yes.
Okay, so Courtney, if you want to get that up, and once that's up, Jenny, you could take us through that.
Sure, thank you. And I may just start just talking in general about the economy. I just want to thank you all for inviting Chandler here tonight to go over the city's quarter end investment report. I'm Jenny Linkowitz. For those of you who don't know me, I'm a senior portfolio manager at Chandler Asset, and I work with Jason Schmidt on the portfolio. So I just wanted to start out real briefly looking at the developments in the U.S. economy. So I was going to start off on slide number 3. If we could go to the next slide. This just has, we just have a general economic update in general. I wasn't going to go through all the, the text that's on there, but I do think it's important to note that the National Bureau of Economic Research did decide and that the U.S. economy entered a recession in February of 2020. So it's official. It's possible that we're already on our way out of a recession. We won't know that until after the fact. So the NBER has a bunch of criteria that they look at to try to determine that. But the U.S. economy, I think it's fair to say, has had a very strong rebound in the third quarter off of the lows that we saw back in March and April. However, we are starting to see signs that the recovery is leveling off a little bit. And that's partly due to some of the uptick in COVID-19 cases that we're seeing around the country. And it's also due to the expiration of some of the enhanced unemployment benefits that were really having a major effect on the U.S. economy and the consumer in general. So as a result, the Fed has decided and announced that they plan to leave interest rates low for as long as it takes for the U.S. economy to recover. And one of the main things they're looking at in their dual mandate is the employment picture. So this slide that we have up here now shows the wild ride, obviously, that we've had in unemployment data. So we had the labor report came out a little bit lower than expected, adding about 661,000 jobs. And unemployment rate on the right dipped to about 7.9%. But part of that improvement was due to some of the participants dropping out of the workforce. So that's not necessarily a positive, but we have come a long way from the higher rates that we saw, around 15% earlier in the year. So that's a nice improvement. In California, our rate's a little bit higher. It's about 11% as of September. And that's partly due to our state's heavier reliance on leisure and hospitality and tourism and things like that. So it's something that we're watching very closely. And the next slide shows another employment slide that shows some of the trends that are going on in the market. Unemployment claims, the green bars ticked up to 898,000 as of the October 10 week. So that's an update from this chart. But from the line on the top, the gray line shows that we've been moving in the right direction and continuing claims have been going down. And they were sitting at about 10 million as of October 3rd. So we still have some work to do, but it's really come back a tremendous amount from earlier in the year. So the next slide shows the impact on prices. So the Fed is obviously watching CPI on the left and PCE very closely when they're making their decisions. And so far, this impact of the pandemic has been disinflationary. So we've been seeing rates on CPI and PCE right around 1.4%. And it's been very similar in California as well in our area. But core PCE, which is the gray dotted line on the right, is the metric that the Fed watches the most closely because it excludes food and energy, which tend to be very volatile. And so that's sitting at 1.6. So we're still well below the Fed's 2% target. And they've indicated at the Jackson Hole meeting and other speeches that the chairman of the Federal Reserve has given that they're willing to leave rates low for a prolonged period of time. And they have other tools at their disposal that they haven't even used yet, like yield curve control and things like that. So they've basically are using flexible average inflation targeting, meaning that they're going to let inflation run above 2% and wait for the economy to recover and just have it be 2% on the average over time. So we think that this is just a signal that they're going to keep rates low for potentially years to come. So we're going to watch that really closely. Okay, looking at the next slide, I think we've got gross domestic product. So this is obviously a metric that took a major dive in the second quarter, negative 31.4 annualized GDP. However, this is an annualized number. So the actual decrease in economic activity in the US was about negative 9% if you don't take that into account. Now we're expecting at the end of the month, we're going to get a reading on third quarter data. And we're expecting that's going to be around positive 25 to 30%. So we're expecting a big rebound. But overall for the year, and kind of this depends on the course of the pandemic, of course, and what happens with that and what happens with fiscal stimulus. But we're still expecting that the US economy is going to end up down somewhere between -3 and -5% for the year. Okay, then taking a look at the next slide. Okay, so does anyone have any questions about the economy before we move on to the account? Okay, great. Hearing nothing. I'll just start talking about the consolidated portfolio that combines all of the city's assets in general. So this dashboard just shows the portfolio from the 630 data on the right to the 930 data in the middle. And you can see that the modified duration, the interest rate risk of the portfolio was sitting about 1.44. So it was below the benchmark with some of the liquidity in the portfolio. The purchase yield has dipped from 1.75 to about 1.5, but still quite strong. And the market yield, which would be the yield you would get if you invested a similar portfolio today, has gone down to 0.33. So that means that you've got some unrealized gains in the portfolio as well. The quality is quite high. It's just one notch below AAA. And then it looks like the assets, the portfolio size dropped from about 156 million to 143 million, which is a drop of about 13.5 million, which we typically see assets utilize this time of year, liquid assets by California agencies. So taking a look at the next slide, we've got the purchase yield history for the entire portfolio. And so you can see it's been trending downward, but it still is staying relatively high compared to other short-term investment vehicles. And taking a look at the next slide, we've got the earnings comparison from last year, which is the gray bar, and this current year is the dark green bars. So you can see that along with yields dropping, you've also seen earnings off about 120,000 for the quarter as well. And so taking a look at the next slide. Okay, so portfolio characteristics here. Major changes that I see just looking at this are drops in LAIF as some of the cash went out, and also a drop in US Treasury exposure because we had a large number of maturities of US Treasuries over the course of the quarter. Those were not reinvested back into Treasuries. And then taking a look at the sector distribution, the previous quarter's on the right and the current quarter is on the left. And it basically shows an increase in US agencies compared to other asset classes. And it's kind of interesting what's been happening in the market. So agencies are like, for example, Fannie Mae and Freddie Mac and Federal Home Loan Bank. And so they've issued a lot of callable securities in the past, and investors have been buying those. And now that interest rates have dropped, we're seeing all those getting called wherever it makes economic sense. So basically the agencies have gone out and they're refinancing their entire portfolios. So in order to do that in such large volumes, they're having to pay a premium. So we're seeing good value in US agency security bullets. So non-callable agencies has been where we've been focusing. With the Fed intervention in a lot of the markets, they're buying corporates, they're buying mortgages, they're buying treasuries, they're buying all kinds of things. They've kind of disrupted a lot of the other markets, and we feel like the corporate bond market is fully valued right now. So we've been focusing and getting more value out of high quality US agencies. And taking a look at the next slide, we've got the industry holdings, and it's very conservative, as you can see. About 60% of the assets are in US government securities, and then you've got about 27% in LGIPs, and then the remainder is diversified across different industries. The next slide, please. And this graphic depicts the change in the corporate holdings in the portfolio by industry. So, a couple things I just want to point out in general. You can see there's quite a bit of exposure to the banking industry. There's some CDs and there's some investments in that industry in general. I do want to just emphasize that this recession, the banks have been much stronger due to some of the regulation and some of the things that happened from the last financial crisis. So this time around, the banks are in a much stronger position than they were last time, where the last time they were kind of leading the issues with the economy.
Right.
So yeah, so it's a much better place to be. The other area where we have a lot of exposure is technology and electronics. And that's an industry that's done quite well with the stay-at-home economy. So that's a lot of those issuers have been doing quite well. And then also the automotive industry. And that's an industry that was down. Some of the issuers were downgraded early on in the crisis. However, we've seen that industry bounce back quite a bit. It's still down about 5% year over year, but they've come back a long way from the shutdowns that we saw back in March and April. And a lot of people are buying cars now who maybe don't want to get on public transportation to go to work, or they don't want to get on an airplane, so they go on a road trip instead. So some people that didn't buy cars before are starting to buy cars now. So those sales have come back, not 100%, but most of the way. Okay, next slide, please. The quality distribution. Most of the assets are rated single A or higher in the portfolio per code. There's some assets that have Moody's or Fitch ratings, but not an S&P rating. And then there's some things like FDIC insured CDs and things like that don't have ratings either. Also cash, like checking accounts, things like that don't have ratings. So that's what that NR column is. Okay, next slide, please. Just taking the duration distribution for the portfolio, you can kind of see that the city has quite a bit of liquidity there, but also has some assets extended out longer term as well. Okay, next slide, please. Okay, this is the duration distribution, just excluding cash. So you can see the profile of the remainder of the assets. Next slide, please. Okay, this slide is the total return for the portfolio. So since inception, 2013, which is about 7 years, the portfolio has on an annualized basis returned about 1.82%. We've seen particularly strong performance in the last year because of the drop in interest rates. So it's been about 4% over the last year or so. And then the unannualized 3-month performance has been about 0.23. So any questions about the performance, the comparison to the benchmark?
Jenny, no one's asking you questions. They always ask Jason all kinds of questions.
Feel free to ask. But I'll keep plowing through if I don't hear anything.
Okay.
Feel free to chime in.
I just want to let you know that we're here.
Okay, thank you. Okay, next slide, please. Okay, we've got total return net of fees. So looks pretty close to the benchmark for the since inception data over the last 12 months. We've had really strong performance. Next slide, please. Okay, the yield comparison of the portfolio is on the right, so 1.51. And you can see how that compares to other short-term investment alternatives. So because your portfolio has a longer duration, it's been able to hold on to its yield for a little bit.
This is really stark compared to the last one. I mean, just in terms of seeing where rates went.
Mhm.
But actually the last a couple ago, but
Yeah, it's been really startling. And I mean, this is a perfect example of why you want to have a longer term strategy. So the city's done everything right as far as having core assets invested out longer term, because you never know when something like this can happen. So we've seen LAIF drop. It's sitting at about 0.61 right now. And they gave an estimate that they think it might be down to 0.5 by the end of the year, but we'll see. It's actually the yield for a liquidity vehicle on LAIF is actually pretty good. Money funds are down to basically 1 basis point, and commercial paper, the Fed's been involved in that market. So, and also a lot of corporations have termed out their debt as well. So there's just not a lot of commercial paper available to buy at this moment. So that rate is very little different from a treasury. And obviously treasuries are close to zero. So there's just fewer places to hide right now. Okay, next slide, please. Okay, so this is this shows the yield curve basically. And you can see that it's basically steepened a little bit since the last quarter. I mean, I do want to point out that a year ago, the yield curve had an inversion to it. And so when you see that, you generally want to invest longer term because it's predicting a recession. And it didn't look like a recession was in the cards, quite frankly, a year ago. I think, I didn't hear anyone saying that there was going to be a recession. No one predicted that COVID would become this huge thing. And so, once again, the treasury curve inversion was the time to go long. And it was the time to, even though you were getting a lower yield, to invest your assets longer term. So it's really been quite startling. But now we've got a normal yield curve, meaning that you get paid more for going longer duration, which is, in the end, that's positive for banks. It's positive for investors like yourselves. And all these lower yields mean that you've had quite a big mark-to-market gain in the portfolio. So that's the bright side of the story. Next slide, please. Okay, the next slide just shows the city's consolidated compliance report. And the entire portfolio is in compliance as of the end of September. And we have pre and post-trade compliance that's monitored by a dedicated compliance team. So this is very carefully programmed into a Bloomberg system that checks all these metrics to make sure that we're following what your policy says and what the state code says as well. Okay, consolidated holdings. We've got a list of the issuers. If you have any questions about those, I'd be happy to answer them. Otherwise, we can scroll through the holdings.
Jenny, Supernationals, is Chandler still out there buying those? Are they attractive at this point, or pretty much along with treasuries, very, very low yields?
Yeah, that's a great question, because Supernationals, we haven't participated in for some time because they've been trading kind of in line with agencies or even rich to US agencies. So that hasn't been a sector that we've really been looking at. But recently, World Bank did a large $6 billion issue and they paid up a little bit for it. So we did actually participate for some accounts, like the 1 to 5 strategies. But as far as your account, you've got a healthy amount of Supernationals there. So we have exposure to it. It's, as far as an asset class, it's not something we've been aggressively adding to just because we don't feel like we're getting paid. And we do feel that it has a little bit extra risk than a US agency because there are other governments involved. There is, with the current environment, the US has pulled out of some multinational agreements. We think that that would be a very remote chance that that would happen. We're only buying the DC based Supernationals in general. And those are permitted by California codes. We're buying the most conservative ones where the US has the biggest vested interest. But we feel just in general that there should be a little bit of a risk premium paid to the investor. And so if we don't see that, we generally don't invest in it. So we do have some holdings that are legacy holdings, but we haven't been adding too much to that sector.
Thank you.
Next slide, please. Okay, we can just scroll through these holdings unless anybody has questions about something specific that they see.
So Jenny, as you're scrolling, this is Art.
Hi, Art.
How you doing?
Good, how are you?
I'm doing well. Was reading in the Wall Street Journal an article about how recovery from COVID, related to the economy and society, et cetera, isn't probably what the article was saying is that we'll probably see that happen in something like 2024. So portfolio structured as this is probably appropriate if there's truth to that. Would you agree?
Yeah, I mean, I think the thing we have to think about too is that, remember the last crisis, it took 10 years of low rates before we finally crawled out of that. And I don't
Yes.
personally believe that this is going to be as difficult of a recovery, assuming we get a vaccine, assuming we can all get back to our lives next year. I think there's gonna be a lot of pent up demand, but undoubtedly some segments of the economy have, like small businesses and certain industries have suffered and may not be able to come back. So I think there's going to be an adjustment, and it's going to be longer than just, getting rid of COVID. But yeah, so I think, the Fed is prepared for a prolonged recovery process, but I hope it doesn't take that long, but it's definitely possible.
Well, they were bringing in the factor of that people are pretty scared now, and it's going to take a long time for them to get comfortable with doing things like going on airplanes and doing things we used to do.
Right.
Going out to dinner. Yeah.
Yeah, people, I think they've developed new habits that they might, to some extent keep. And it has, I mean, there's been winners and losers. So some parts of the economy are booming right now, like never before. And, other parts are really, really struggling. I mean, one thing, in the economy too, that we've seen is the consumer. You mentioned that they've been really conservative, and we've seen the savings rate at record levels. Back in April, it was all the way to 33%, and now it's about 14%, which is still extraordinarily high. I mean, usually I'd say it's like around maybe 6% if we're lucky, or 8%, but it's 14%. A lot of people hung on to their government stimulus that they received, and they're still paying their bills. Credit card delinquencies and auto payments, I mean, forbearances on mortgages are way low, much lower than anticipated. I mean, obviously some people are impacted, but in general, retail sales have been strong. I mean, it was up 5.4% year over year. So they're expecting a really strong holiday season. So I think, it's as long as, a lot of people are able to find other jobs in other industries. If, they're having to go from working at a restaurant, maybe to go working at Amazon or UPS or something. But, a lot of people are able to make the adjustment, but it's still, obviously the impact, there's going to be a hangover from it, I think, without a doubt.
Yep. Thank you.
Thank you for the question. Okay. Got the maturity
You
schedule.
probably read the same article.
Okay. We can keep scrolling through until we get to the next section. The transactions shows what's been done over the course of there's been a lot of treasury maturities, and we've been purchasing 3- and 5-year agencies mostly is what's going on there.
Perfect.
Okay, and taking a look at the Chandler managed portfolio kind of by itself. Just want to review the objectives real quickly. Safety is the first objective, particularly in an environment like this, and then liquidity is next. So yield is the third consideration when those two have been met. So we're putting extra emphasis on that. We're managing versus the 1 to 3 year U.S. Treasury and Agency Index per the policy, which we'll talk about. We're actually managing the strategy right now per the management directive to a 0 to 5 strategy. So actually the city made a really great decision back in 2019 to extend the portfolio from a 1 to 3, which is about 1 3/4 duration, to a 0 to 5, which is actually over two duration. So it's about 2.15 or 2.2. So because we did that in 2019, when rates were relatively high, they were declining, but they were higher. We were able to extend the portfolio at a very good time and add duration at a great time. So that was an excellent decision on your part. So the strategy when we're investing the funds is to purchase high quality securities that comply with the policy and California code as well. So taking a look at the next slide, I think we've got the dashboard that shows the characteristics of the portfolio. The benchmark, the 1 to 3 benchmark per the policy is on the left. And then the portfolio is in the center. And then on the right, we have the previous quarter to compare to. So you can see the modified duration is sitting at 2.14. So that's about neutral with the 0 to 5 benchmark. So we've been keeping portfolios very close to neutral. There really isn't, with all the volatility that we're seeing right now. We could see some additional volatility coming up with the election. So we're really not going too long or too short at this point in time. The purchase yield for the Chandler managed portfolio went from 2 to about 1.83. So it has declined over the course of the quarter. The quality is AA+, so it's 1 notch below AAA, which is the highest. Total market value, we've seen go up actually about 191,000. And we've got unrealized gains in the portfolio as of quarter end of about 2.45 million. So significant unrealized gains have been accrued, and that's captured in the market value.
Jenny, if we could go back to the benchmark, and I realize you're using the benchmark that's specified in the investment policy, but I think I talked to Jason before about for this portion of the report to actually use the 0 to 5 benchmark. I don't think we need to conform to the investment policy, and because we're conforming to the investment policy as far as using the benchmark for the consolidated portfolio. So would it be possible to, for the Chandler portion of the portfolio, the external portfolio, to use the 0 to 5 benchmark on this report and other reports within this section?
Yes, absolutely.
Okay.
Yeah, I'll work with Tara on that.
Any committee members have any thoughts on that?
I would just add to that I think that's, I think that's a better benchmark for this portion of the portfolio. I think maybe what we did before, did we use both the 1 to 3 and the 0 to 5? Or I'm trying to remember, but I think we had the 0 to 5 on there. Maybe we also had the 1 to 3.
Yeah, I thought they were actually blending it, because I know, and maybe that's the performance part of it.
Yeah.
Is it? So you have the blended benchmark in the performance part.
Yeah, we have. I'd have to take a look and see what we got in this particular report, but we did create a blended benchmark for the city that we could utilize if you'd like. So we can take a look and see what this report has and if we need to change it.
Yeah, I'm just going up real quickly to the performance part of it.
I'm not even sure if the performance is in this part of the report. It might be
No,
just,
it's not.
might be just in the consolidated portion. So
yeah, and you use our policy in that probably the total return net of fees, which only shows, well, that's the consolidated. No, it's actually just the Chandler. That would be the place to put it also. So the total return net of fees, Jenny, on page 20,
okay.
Along with the really this whole section on the Chandler managed in terms of the duration, average market yield, average maturity. Unless there are any objections by other committee members, I'd like to see that 0 to 5.
Sure.
Any other comments? Committee members?
No, I agree.
Okay,
We'll get
No, I mean, I
that.
think if you reference the reports in the past, they had it. So you can probably see examples of where we did have that, because I know we had it in the past.
I thought we did, yeah, because I thought I love the idea that you guys were able to wait it for the time that we didn't use the newer strategy for a portion of it, that you're able to phase that in. And so yeah, maybe go back and check the previous report or two to see if it was on there and where it was on there. And if you have any questions, give me a call.
Sure. Yeah, we can absolutely use the blended benchmark for the net of fees and, and where it makes sense to do that. And then for the characteristics of the Chandler Ranch portfolio as well.
Yeah, perfect.
Great. Yeah, well, I'll get that changed for next time.
Thank you.
Mhm. Okay, next slide, please. Thanks, Courtney. Okay, so taking a look at the portfolio characteristics. Basically, this is the quarter-over-quarter change. We saw a decrease in treasuries and corporate bonds, and the corporate bonds were mostly just maturing off and not being replaced. And the same went for treasuries. And we saw increase primarily in the U.S. agency sector, and then we also had some cash as well that didn't get invested immediately. Next slide, please. Okay, taking a look at the sector distribution. It shows the same information. Basically, corporate credit, isn't an area that we've seen a lot of opportunities in recently, particularly that we're not out of the woods as far as the recession. So we haven't, the Fed is involved in the corporate bond market. They've been buying ETFs and even high yield bonds for the first time in the form of ETFs. So even they're talking about being involved in the corporate bond market had a huge impact on the valuations for that sector. So they immediately went up in value. And when the Fed actually started coming in and buying, they gained even more value. So we're really not seeing a lot of a risk premium being paid to investors, but we still feel that corporations have a fair amount of risk. So we're really hesitant to commit, to purchasing corporate bonds at these levels. So we haven't seen a lot of opportunity there. So it's been some time since I've purchased a corporate bond for the portfolio, but we do still have corporate bond exposure. We watch it, we monitor it very closely. We have some bonds that we purchased at much higher yields earlier in time. So we've still got about 15% in corporate bonds. So lighter than usual. You've got a 20% limit on corporates. So it's lower than state code, which is 30%. So you've got a more conservative band on this already, and we're operating well within that. So, the vast majority of the assets are U.S. Treasuries and agencies. And then we've got a small amount, 3% of supranationals, 2% ABS, some CDs, and then about 4% was sitting in cash at that point in time.
Jenny, are there any issues that you have in the city's portfolio that you're at all concerned about?
No, that's a good question. We did see downgrades in a couple of names that are held. I believe Oracle, which you have, got downgraded to the low A spectrum. So they're still within the A category, but they did a bunch of share buybacks that impacted their credit rating. So that's one we've been watching closely. We were watching the autos very closely. You've got Toyota in the portfolio, but that was AA rated before. So it still had more cushion. Honda got downgraded pretty severely, but it looks like you don't have any in the portfolio. So your portfolio is in really good shape. And we can take a look at there is a page that shows all the issuers actually.
Right.
As well.
Page 49.
Yeah. So if you
Next page.
Oh, it's that's perfect timing. Great question. Yeah. So if there's any names that you see here that you are concerned, if anyone's concerned about, I'd be happy to talk about them. But we've been monitoring them all very closely. You can see there's quite a bit of diversification across different industries, and a lot of them are very highly rated. Like Walmart's been doing very well. Berkshire Hathaway is doing well. PACCAR is a trucking manufacturer, so they've been doing great. John Deere has been doing fantastic. They've been benefiting from, some of the international recovery. So they've been, IBM, so we have, we try to keep it, Apple is very high quality. We try to keep it very well diversified and up in credit, just in general.
Okay, great.
Okay, next slide. Okay, this just shows the duration distribution. If you have any questions about it, I'd be happy to answer them. Next slide, please. Compliance report shows fully compliant as of September 30th. Next slide, please. Okay, and with that, if you have any other questions, I'd be happy to take them. Otherwise, I'll turn it over to Mark.
Great. Thanks, Jenny. Okay, so we're picking up on page 53 then. And as you can see, as usually is the case, the average maturity and duration quite a bit below the benchmark. A lot of that is because we keep so much money in LAIF. So that really hasn't changed too much there. I mean, you can see it has gone down. The average maturity, the duration is not. Average purchase yield, just as Jenny pointed out, with the consolidated and Chandler, has gone down some. And average market yield has definitely dropped also, as has the market value. On the next page, page 54, portfolio characteristics. I would say the main thing is, there's a big increase in the money held in the money market fund. That's mainly because I've just been kind of agonizing about whether to put that. We had a couple maturities toward the end of the month, whether to put that in LAIF where we get a nice yield, or knowing that LAIF is going to be coming down in yield, or to, like Chandler's been doing, put it in to some longer term agencies. And it's such a tough one, because even though there is a little bit more of a spread there, the yields are just so low, and to kind of lock that in for 3-4 years is a tough call. But any comments on that, Bill, from your perspective?
Well, not much other than what Jenny said. The big question, of course, is how long rates are going to stay low. And of course, LAIF will ultimately track lower. And so I just think you got to handle that kind of carefully, because LAIF's got a great yield right now, but LAIF does not protect you, in any kind of a long-term decline in rates. So you just sort of have to recognize that LAIF is a great place for short-term cash, but it just doesn't replace the longer-term components of your portfolio.
Right. Yeah, in one sense, part of me always says, well, that's what we have Chandler for, but at the same time, I want to be as prudent as possible. So, other than that, that's the main part of the increase. Obviously, the LAIF has gone down quite a bit, just simply because the city has been having, the negative months where they draw out more than comes in. And the U.S. Treasuries have gone down because of the maturities there, as a couple of the agencies have been called. Next slide, sector distribution. Just kind of a pictorial of what we just saw up above. Please interject if you have any questions. On the next slide, on page 56, the duration distribution. I don't like to spend much time here because it has so much in LAIF and cash. If we go to the next slide on page 57, that's a better picture of the money that is invested. And basically you just have the longer maturities going down to the next one as they decrease in time. And then on page 58, you have the issuers. And that pretty much sums up the internal portfolio. The following, you could just kind of slowly scroll through the other pages, Courtney, certification page. We never really spend much time on there. We could go to page 63, which is the includes the total pension portfolio, which we have nothing to do with, but other than to put it on the report for public disclosure. And you can see how that's diversified. And then page 64 has the investment allocation. Maybe if you go down to page 66, Courtney, the monthly cash flow receipts graph, and you can see pretty much what happens there in terms of disbursements versus the receipts. And that's really all I have to comment on, unless there's some questions for myself or Eric on the cash flow for the city.
Yeah, this is probably more for Eric. So do you feel like the months that are there on page 67, like maybe the next 6 months, you feel pretty confident in those numbers? Where we're negative?
Oh yeah, I mean, yeah, just from the standpoint of that, just has more to do with the inflow of certain receipts. So yeah, there's nothing at this point. We're monitoring monthly on our revenue, and no concerns on our part, sir. But thank you for asking.
Yeah, well, I mean, there was that little bit in the paper, about the shortfall, and I would expect that that's going to continue for a while. I know that there's plenty of money in life to cover shortfalls, but what you're saying is that there's no need to change strategy or to do anything at this point. Maybe 6 months from now, we'll see where our situation is. Right.
No, and with that, just to let the group know, so for fiscal year 1920, we have closed the books out on that, and it was just recently presented to the city council. When we started the pandemic in March, we put a blindfold on and we forecasted $2.5 million in revenue losses. At the end of the day for that fiscal year, we came in at about 2.1 in revenue losses. And so we weren't even, we were a little bit under, which is great. We like that conservative approach, but we had well over $1.5 million in salary savings because we left positions vacant. So we had a hiring freeze. And then we also realized some other revenues from reductions in expenditures. So no borrowing, no nothing to close out the fiscal year. When we get to March of 2021, that'll be our mid-year point, and that'll be really the true test of, do we need to do anything, in terms of reacting to anything negative at this point, which I'm not saying there is anything negative, but that's when we'll have a better picture for the fiscal year that we're currently in.
So Art, can I comment on that a little bit also? The paper, they like to make a big deal out of, we're down $2 million. But what happened is we have a lot less expenditures. So look at our recreation. We couldn't have recreation classes. So we're not making the money on that, but we're also not expending it.
Exactly.
So we don't have any events, things that cost the city a lot of money. So that's where we're saving. So we're okay.
Completely agree.
Well, sure looks like it.
Very good. Any other questions? All right, if that's the case, I need a motion to accept the investment report first quarter of 2020-2021 as presented.
Make a motion to accept the report.
Thank you, Bill. A second?
Second.
Go ahead, Art.
Okay.
I think
All
Kathy
in
was first.
favor?
Aye.
Any opposed? So moved.
Yeah.
Okay, so I asked Jenny to hang on since we're going to be doing the investment policy review. To me, this is really one of the most important meetings that we do all year for obvious reasons. The red line version that was sent out in the package, and I apologize that it got to you basically today for today's meeting. And that was really my doing, not Chandler's. I was delayed in asking them to put it together, but I think what we'll do is we'll just kind of go through it piece by piece. Courtney, can you pull up the red line version for us
Yes.
to look at? And then Jenny, if you want to take us through that. Jenny and I spent about 20-30 minutes talking about this before the committee meeting. So why don't we go down to page 7? We'll skip the first one, which is the deletion of the management directive, because we'll handle that at the end. If we go down to page 7 right there you go.
Okay.
So go ahead.
So the first, and I just want to just emphasize that these are recommendations that Chandler has. They're not, obviously, none of them, are required whatsoever. So you can do, what you feel is appropriate. But the first change that we were suggesting was adding language to the policy's commercial paper permitted section. And the reason we were suggesting this is to make it more in line with California code. So California code allows for 2 different types of commercial paper. And the first one is plain corporate commercial paper issued by a corporation, for example, Exxon or something like that. And the second type of commercial paper that's permitted by code, and it's mainly geared toward asset-backed commercial paper, is commercial paper issued by an LLC type entity that has, typically these have a bank sponsor. They don't have to, but often they do. And then they have other program-wide credit enhancements, such as structure, and they can have reserve accounts and surety bonds, over collateralization, things like that. So California permits the city to buy this type of commercial paper as well. So we're starting to suggest that public agencies put this in their policies. And one of the reasons is because the SEC just recently came out with revised definition of accredited investor, which permits government bodies to purchase 144A or QIB private placement paper, provided you have assets of at least 100 million assets under management. So because of that, that starts to open up other types of commercial paper. A lot of commercial paper is private placement. A lot of it's 144A, and a lot of it falls into this category where it's it's not issued by Procter and Gamble or something. It's issued by one of these structured product type issuers. So we just wanted to suggest that you might want to consider it for the future, because there could be opportunities down the road. We're not currently seeing any opportunities in commercial paper at all, unfortunately. However, this is something that would bring the policy more in line with government code and would potentially open up an opportunity for the future should one arise.
Bill, could I have you weigh in with your thoughts on this?
Oh, well, I think it's a good idea. I mean, that world is changing, or has changed a lot. And like Jenny said, maybe the opportunity doesn't present itself right now, but at least we'll be set up so that if that opportunity becomes more present, we can take advantage of it. So I think it's a good idea.
And you don't see any additional risk by adding these types of securities, or, I mean, not types, but issuers or products?
Not necessarily at all. No, I mean, again, you have to, in Chandler, or if you're buying it, you have to be mindful of the credit metrics of the particular issuer. But I don't think, this structural credit enhancement represents more risk necessarily at all.
Okay. Any comments by other committee members?
Yeah, I was just saying that, because you have these enhancements, therefore, the only reason why you need the enhancements is because it is higher risk. In other words, if you have to put a standby letter of credit behind an issuance, then obviously there's a shortfall there. It's the letter of credit that is providing you the assurance. And now I've got to look to who's issued that letter of credit, and what's the strength of that financial institution? What's the quality of that letter of credit? So I think there is a higher risk, but yeah, again, it depends on who it is, and we need to understand, what that risk is and how they've offset that by whatever the enhancements are.
Yeah, and of course that would be our job as well to assess that risk. So if a major bank is sponsoring the program, they'll typically issue the letter of credit, and oftentimes it'll cover the entire amount.
Yep.
They'll just use this as a way to maybe, get it off their balance sheet or something like that. But that would be part of the credit analysis process.
Mhm.
Yeah,
And
like a
then,
JP Morgan Chase. They're known for doing this.
and then Jenny, in terms of the credit analysis on Chandler's part, you run it through the same way you would run through a corporate bond.
Mm-hmm. Yeah, it would go through the credit committee, and it would need to be on an approved list, and it would be vetted by, the entire credit team.
Mm-hmm. Okay. Okay. Let's see. I'm just wondering. We should probably, in a sense. Let me do it this way. Through each point, I'll ask if there are any reservations from committee members as far as adding it. And I'll say that since as treasurer, I would never be buying commercial paper anyway. This is really only for Chandler's part of the portfolio, the Chandler managed portion. So I don't have a problem with adding this. Could you each weigh in as far as whether you do or not?
Well, I mean, I'll just say that I think we've hired Chandler to do this analysis and manage our credit risk. And, I think they're capable of doing it. And so I think we're okay doing that. As to Art's comments about the issuers being high risk, I mean, you're right. But once they take advantage of these credit enhancements, I think the investment that the city would be buying is not necessarily higher risk. And so we have to obviously leave that up to Chandler to make that determination.
Okay.
It sounds like they're doing adequate due diligence on it.
Hey, Al, good to see you.
Hi there. I've been here the whole time.
So can I just ask one comment? Bill said that he wouldn't be worried about adding this to the structural part of, paper that we could buy. So when Chandler does purchase something, they don't come to us first then to ask us again if we want to do this. Is that correct?
That's
Not-
correct. If it's in the investment policy, then they have, that's why we set the investment policy, Kathy, with that in mind, both in terms of what can be bought and what can't be bought, and also as far as what percentage of our portfolio it can make up.
Okay. So they're also going to follow that, except we're expanding it now to try to get other opportunities, but it's going to go through, as Jenny said, it's going to go through the full committee on that. So I guess we're going to have to be relying on that it's not going to be anything risky, which Art said they're going to take a lot into account, correct? Looking at the credit letter and any enhancements, things like that. Okay.
Absolutely.
Right. I just wanted that clear. I wasn't sure if that's what it meant.
Yeah, and just because we're adding this doesn't mean that we may never even utilize it. It's just something we're asking for in case an opportunity were to come up that we think it might be beneficial. If we don't see something that, if something's too risky, we're not going to invest in it.
Okay.
Is
Right.
there a limit that you could buy of this?
Yeah, so the limit on commercial paper is currently 15% of the portfolio. And so we're going to talk about that as well.
That seems pretty high, isn't it?
Well, the government code is currently 25% of the portfolio.
Hmm.
And your policy actually has it 3% per issuer, I believe, for corporates and CP. So it's a little more conservative, which is fine. You know, I think, you know, I don't think, you know, a lot of people have 5% as their limit, but I think having it low is appropriate. But there's another, you know, there's another SB 998 was recently passed that takes effect next year, which permits cities and counties with assets of $100 million or more to purchase commercial paper up to 40% of the portfolio. And I think that's mostly to help agencies that have a lot of short-term cash flows and things like that manage their own portfolios without having to necessarily use an LGIP or something. So so that's one of the things we're going to talk about as well. But your current limit is 15%.
Okay. And so I guess what I'm asking, is there any opposition to adding this? Okay. All right, let's go to the next one then. That would be on page 9.
Okay, great. So I was just speaking about SB 998 that was passed in California and takes effect on the 1st of the year. And one of the elements of that bill was to allow local agencies to purchase US government securities with a 0 interest accrual or a negative interest accrual. So this is something that that they've put out there because there's a chance there could be negative interest rate environment in the future. So it's something that, you know, you could adopt it or not. It's really up to you, but it's something that the state is now allowing local agencies to do in the event that we end up in a negative interest rate environment.
And so obviously, you know, there might be a instance where we need to park cash, and all we are concerned about is the safety of it. You know, we've been using LAIF for that, but in my mind, we never know what the future holds. And there have been, you know, other countries that have been in 0 interest rate environments. And I think this just simply allows us the option to do that as long as it's backed by the US government. Any other thoughts out there? Is there any opposition to adding this language into 4.7.3.3? Okay.
Yeah, I'm okay.
All right, Jenny, why don't you go to the next one further down on that page under the credit rating downgrade?
Sure. Okay, and hopefully we never have to utilize the 0 interest accrual exception. We're, you know, just trying to keep everything in line with code as much as we can. So for the credit rating downgrade language, we're requesting that we add a provision that would allow Chandler to take action on a security if there was a credit downgrade, for example. And for some reason, we weren't able to get a hold of anyone at the city to be able to take action on it as we feel is appropriate. And this is something that, you know, I think would come into play if something happened very quickly in the market. You know, it's one of those things where if, you know, for example, if the treasurer's, you know, on vacation or something and we can't get a hold of them for a couple of days, and in the meantime, the market's tanking, this scenario would allow Chandler to act without getting permission explicitly from the treasurer. However, I do want to emphasize that Chandler does try to communicate as much as possible. You know, if there's any kind of credit event that's adverse to the portfolio, we definitely try to keep everyone in the loop. But we were just asking that you consider allowing Chandler to act on a, you know, if a security were to be downgraded below the policy minimums.
This is a wonderful idea. Thank you.
I agree. And Chandler has been really good about communicating with me in the past we haven't had this situation, but we've had a situation where they wanted to sell an issue prior to maturity and replace it with an issue with a longer maturity and a better interest rate. And they haven't done that without asking me first. So, but this case, I love this idea, especially in the environment that we're in. So I support anyone, any other comments or anyone not doesn't think it's a good idea.
I think it's a good idea, but I'm Chandler. I'm certain that Chandler will make sure that they identify how they've tried to contact the treasurer and have a record of that before they take action.
Yeah, I mean, we could potentially write something like that into this
Mhm.
as well. But I think, as a matter of practice, we,
Yeah.
we reach out to people. It's not codified anywhere, but it's just something that we do as part of our corporate culture.
Yep.
Do we have a backup person for them to contact if they can't reach our treasurer?
Well,
Wondering
yeah, I
if
mean,
we have that.
you can reach out to, well, you used to Judy Vincent when she was there, but I think the other, don't you also have the ability to, I'm trying to think who the person is, where if I'm not available, I'm assuming it's Eric, but I can't say that with certainty.
Thought it was two, Mark.
Yeah. Jenny, do you know offhand?
Typically you're right. We have contacted Judy in the past. We have you as the primary contact, but if you'd like to set up Eric as a secondary contact as well, we can certainly do that.
Let's do that. Yeah.
Okay.
Okay. Any other comments or anyone doesn't feel that this language should be in there, or again, with any of this, if you think it should be modified in any way, that's also a possibility. Okay, let's go to the next one then. That would be on page 10. And it's a little bit hard to see, but it's just the percentage. So currently, commercial papers at 15%. Chandler is saying that California code allows it to be 40%. My own personal feeling on this is that we leave it at 15%. And as we've talked about to Chandler in the past, is because from my perspective, the internally managed part of the portfolio, even though I have the ability to buy commercial paper, at least while I'm treasurer, I will not be buying commercial paper. So 15% really means something like 25 to between 25 and 30% that Chandler can of the portion that they manage. But in any case, I think the appropriate number for the city's portfolio is 15%. So my recommendation is that we keep with that number. Any other comments?
I'm going to follow your suggestion.
Historically,
Bill,
we haven't come anywhere close to 15% either. So,
right.
So
Bill,
the reason
any thoughts on that?
the reason
No,
for all
I'm-
these changes is just to have more opportunities, correct?
correct.
Okay.
Yeah, the Chandler generally will recommend whatever code, California code says, but there are many instances, Kathy, where City of San Clemente's investment policy is more conservative than what the state allows us. So in this case, and actually this isn't the only case. I think there are other ones. Corporate bonds, I think, is another one. So in either case, my recommendation is that we keep with 15%.
Okay.
And I think that's good. I mean, typically the city will be investing, money in LAIF. LAIF's going to be something that performs better than commercial paper, which is probably why they haven't invested in commercial paper a lot. So I think 15% be sufficient. And If things really change someday, we can always address that in the future.
Okay. Any other comments? Okay, so that we'll keep it at 15% rather than going with Chandler's recommended 40% per the state code. All right, the next one is on the benchmarks, next page, page 12, I believe. So Jenny and I talked about this a fair amount. So what I think we're going to do is we're going to keep it. Well, Jenny, what you made a comment that more and more agencies and cities are not even having a benchmark. Could you speak a little bit to that?
Sure. So in our discussion, I was talking about how many public agencies don't specify a benchmark in their investment policy. And the reason that they don't is because they want the flexibility to change it with a management directive to the manager rather than having it set in stone in the policy where that's only changed maybe once a year at the most. So that's another option would be to take out a specific benchmark reference altogether and just talk about a generic benchmark that's an appropriate duration.
Okay. So here are my thoughts on it, committee, and that is that as we discussed earlier, we're going to have Chandler use the 0 to 5 benchmark, which they were suggesting we replace the benchmark with. But we're just going to have them use that on when they compare the Chandler performance to a benchmark, as opposed to the consolidated or internal portion of the portfolio, which will remain to whatever we designate, assuming we do designate one in the investment policy. So my feeling is we should keep the primary benchmark in there as the B of A Merrill 1 to 3 U.S. Treasury and agency. We've had the Merrill Lynch AAA to A corporate and government index as more of a reference, but not a primary. In one sense, I think that is a little bit confusing because why is it a reference? My feeling is we should probably just go down to one primary benchmark and keep it the one we have. Any thoughts on that?
The more you have in there, the more information we can see.
Mm-hmm.
At least you should definitely have something in there. So doesn't hurt having something in there.
Yeah, no, I agree. I mean, I think we definitely have for sure the primary one, and my feeling is we should keep it where it is.
Mm-hmm.
And just have Chandler use the 0 to 5 benchmark that they're suggesting only when comparing Chandler's performance. So that's my feeling. So Al, what you're saying is the more information, the better. So you're in favor of keeping both the primary benchmark that we have as well as the reference benchmark. Is that right?
Yeah.
Okay.
More for us to see.
Any other thoughts?
The only comment that I would have as a layperson, it's been easy to be able to gauge their performance the way it has been. So I'm not sure how that's going to change it. I've been happy with how it's been. It's been easier for me, but
Okay.
I'd like to hear what our analyst has to say.
I think Kathy's referring to you, Bill.
Yeah.
Well, I'm comfortable with benchmarks and familiar with them. So I like them. I mean, I'm good with using 0 to 5 and the 1 to 3 because I think if you take a little bit of time to understand them, they provide a valuable way to determine how the portfolio is doing. And there's a lot of caveats when you go through that analysis, but they're, in my opinion, better than not having them.
Okay. So Any other thoughts, Al, or Al, you already commented. Art, any comment from you?
I agree with Bill.
Okay. So Bill, just to make sure I understand you correctly, you're in favor of just keeping the policy the way it is with the primary and reference benchmark, and then we'd be using again the 0 to 5 with the just Chandler's performance monitoring.
That, I would agree with that, because obviously they manage a longer duration portfolio. So I think the 0 to 5 is appropriate there. And I think the 1 to 3 is appropriate for your portion of the portfolio. And, or we could include it in the consolidated, in looking at the consolidated portfolio.
Right, yeah, no, we would be doing that there also. Okay. So I think the consensus is then more information, the better. So we'll keep the investment policy as it is, and Chandler will handle putting the 0 to 5 in the investment report just when looking at their performance on the 0 to 5. And again, it's important to note that when they use that 0 to 5, it's weighted, it's time weighted. So for the period of time we didn't have the new investment strategy in place, they're going to just use the, I believe it's the 1 to 3. But then from the period of time on where they've had the newer strategy in place with the longer duration, it's going to be a blending of both benchmarks, which I think is appropriate. So, okay, so we'll just leave 5.2.1 as is. Very good. So let's see, then the next one is the definitions, and that's on page 17. And this is, Jenny, you can just comment on why you're making this. It made sense to me.
Sure. So we're just requesting a correction of the definition for negotiable certificates of deposit, where it currently states that they're payable upon order to the bearer or initial depositor. That's not actually correct. So they're typically sold on a secondary market. So we're requesting that definition be corrected.
Okay. I'm fine with that. Does anyone have any comments or concerns about correcting that? Okay, so we'll make that correction as recommended by Chandler. So then the only other recommendation that Chandler was making was to eliminate the client directive. And I had wanted this in there before because it gives some transparency to what the city's done. And what Jenny was telling me, correct me if I'm wrong, Jenny, and that was that you were recommending that we take it out, assuming that we change the index. Since we're not changing the benchmark, then I'm assuming Chandler doesn't have any problem with us leaving it in there. Would that be true, Jenny?
That's correct.
Okay. And I don't know that we will keep this in there indefinitely, committee, but my main thought was that we did a, I don't know if you'd call it a major, but certainly a meaningful change in how Chandler manages the money, at least a portion of the money. So I thought it would be good to document it and be transparent with the public about it with it. So that's why I thought we'd put it here. Any issues or comments about that? Okay, so we'll leave that in there. We will not delete it, so it'll stay both in the table of contents and where it resides now in the investment policy. I'm going to back up to 5.5.1, sorry about that, Courtney. I meant to catch it, but it's on page 12. So per the city council's recommendations, even though it's not going to take effect until apparently June 30th, at least that's what Kathy was telling me before we got started. But the way the council has decided to have this committee is they would be taking off the council representative. So Kathy would be leaving us, unfortunately, but they would be adding to replace Kathy another citizen representative, and that they would appoint. And they would be removing one of the two industry specialists, which I won't go into it, but we really only wanted one to begin with. And so they'd be, and Kathy Dietry was fulfilling the second one, and she resigned, and we have not filled her spot on purpose. So it'd be going down to one, and the way the code is now, or has, I think it's been adopted, it just hasn't been put into place until June 30th. And that is the city treasurer will name the industry specialist. So I don't know if Kathy or Eric, you have any opposition to us reflecting in the investment policy now what's going to be effective the end of June, or is it already effective?
It's already affected from the standpoint that the council has ratified the decisions. They've just set dates of when they actually go into effect. So I have no problem with you making those announcements.
Okay. Anyone else on the committee? Okay, so we'll make that change to the investment policy. Basically, we'll be eliminating 5.5.1.2 council member representative, and we'll be obviously changing 0.3 to 0.2 and change the number to 3, and changing 0.4 to 0.3 and changing the number to 1. And then we'll maybe in 5.5 paragraph where it says the city council shall appoint an investment advisory committee, we'll have to change the language so that the treasurer appoints the industry specialist, and treasurer by definition is the chair and part of that committee. So that's not something, so I'll reflect that in the in 5.5 to be consistent with what the council has done.
Mark,
Yes,
may I ask Kathy a question?
of course.
Okay, so what's the thought process of not having one of the council members on this committee?
No, I'm not sure that that was even stated. I was on the subcommittee with Mayor Dan Bain, and we looked at it, and these are things that he was trying to implement, and I didn't have an opinion at the time. It was never stated when we did it. And I was telling Mark earlier that when we had our joint meeting of all the boards with the city council, I had questioned why the council was doing anything to this committee, because it's really not the same as the other committees, you know, and what we were
Right.
trying to do. So I actually can't tell you. You know, I don't know whether they just thought a council member did not need to be on it. You know, I don't know. You know, I could ask that question. I mean, Eric, if Eric remembers, I truly do not remember a reason that we did this.
I have to go
Eric,
back and look at my notes. I don't recall.
Yeah, I don't remember that at all being stated. And I know Mark came to the meeting and had some issues with why we would ask for a work plan, because there really shouldn't be a work plan for this committee. So I thought that some of the items didn't apply. So, I don't know whether we should review it again, but if the treasurer and the rest of the committee is okay with it, unless you feel better having a council member be aware of what's going on so that we can answer questions. That's the one reason I would think that we would want someone on. When there's a question from the dais, it can be answered. But Mr. Sun can also answer those questions.
Right. Yeah, I
I was going to say, I mean, you've got good representation with Eric and Mark, but it's the city's money, and I guess why wouldn't the council want to be present during these meetings?
It was never stated, so I can tell you I don't know.
Okay.
I think I know.
Okay.
I think the council is so overworked that one less committee that they have to sit on, probably the better from their perspective. And I don't necessarily disagree with it. It's always great having someone from council on the committee, but I'm sensitive to how much they give to the city and don't want to give them more.
Well, and it's not like you're communicating with them, and Eric is there, so it's not like there's a lack of communication. I guess for me, it's just a significant disconnect because it's a lot of money. It's the city's money. I would think council would want representation, but that's a personal opinion. So there you have it.
I can think about bringing that up.
Let me review the actual minutes from that council meeting when we did that with the city clerk, and I'll circle back with Mark Taylor because it's never too late. We did some tweaks to some committees thereafter in terms of specifically the public safety committee in terms of correcting some placements. And so once I get the minutes, I'll connect with Mark, and if Mark feels that it should be something that we should have, that would be something that I think that he could convey to Kathy and she could bring back to the council, and we could course correct. So let me look into that, please.
Yeah, personally, Eric, I like the way you guys are doing it. I love the fact that the city treasurer appoints the industry specialists, because that was an issue, as you probably remember, and that's why we ended up with 2, because Kathy, although she was incredibly qualified on many levels to be on the committee, she wasn't dealing directly day to day like Bill was with public agencies. So I like the way they did that. And I think, Kathy, what I had said about the work plan is essentially when we do the investment policy, that is our work plan. We're kind of laying out how we do things. And so we do that once a year. And I think that was my main comment there. But
right.
Anyway.
So I agree. I don't think the interviews for the industry specialists went well, and so we had an issue with that for a couple of years.
Yeah, but it worked out. It worked out. So, and the council came around and gave us what we needed. So I appreciate that.
Of course.
So, okay, are there any other suggested changes by the committee members for the investment policy? I'm going to quickly review them so we can have a motion on it. But before I do that, are there any recommended changes? Okay. So Courtney, if you could very quickly scroll up to the beginning, and I'll just go starting with the table of contents. So as far as the red line version goes, down at the bottom of the table of contents, they had, there it is. They had recommended deleting the management directive, but we're not going to do that. So we're going to leave that in there. And then if we go down to the next page, the only question I had is they put in the effective date, but I'm not sure that that's when the city council meets. Do you have that date, Eric or Kathy, so that we could accurately reflect that?
September 15th.
December 15th. Okay, so that will be changed to December 15th. Okay, very good. And then, so the next one will be then, if you want to scroll down, Courtney, to page 6. And per our discussion there, it's the 4.7.1.6. There you go. So per our discussion there, we're going to make those changes as recommended by Chandler. And again, if I get any of this wrong, please, anyone stop me. So then if you want to scroll down, Courtney, to page 8, 4.7.3, we're going to adopt on 4.7.3.3, investment in any security not issued or backed by the US government that could result in zero interest accrual if held to maturity. So we're going to adopt the recommended change by Chandler on that. And then on that same page, 4.7.5, we're going to adopt the language which gives Chandler the ability to, if they're not able to contact me, if there's a security downgrade on one of the securities that they handling, that they have the ability to take action. If they're not able to get a hold of myself or Eric. And as an aside, they're going to put Eric as the backup contact to the city treasurer.
Right, and then they're going to report back to us anytime they take said action.
Absolutely.
Yep. Well, we're good.
Okay, and then if Courtney, if you want to scroll down to page 10. We are not going to adopt Chandler's recommendation for commercial paper. We're going to leave it where we are, which is at 15%. And then if you can scroll to page 11, the bottom of page 11 under benchmark, we're not going to change that. So per the red line version, we will just keep it as it is. And then page 12, 5.5, it's not red line, but we will adjust that to the per the new code per the city council. And I'll get with Eric to make sure I reflect that properly in the investment policy. And then finally on page 16, Courtney, under 6.33, right there, we will adopt a change per Chandler's recommendation to make it accurately reflect what an NCD, how it operates in terms of when they're traded. And then just to reiterate on page 18, if you scroll down there, where the red line version has us eliminating the client directive, we're going to leave that in there. And that's it. So if somebody could make a motion that we accept those changes as stated and reviewed by myself per Chandler's red line version.
Art?
So moved, Mark.
Was that a motion, Art?
Yes, sir.
Okay, do I have a second?
I'll second that.
Yeah.
Thank you, Kathy. All in favor, say aye.
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 Any opposed? So moved. Okay, very good, committee. Thank you. And Jenny, thank you so much.
Everyone.
You can drop off if you'd like. We really appreciate all your input.
Good to see you again, Jenny.
You too. Be well, everyone.
Thank you,
Thanks.
Jenny.
Thank
Good
you.
presentation.
Give Jason our best.
Will do. Thank you.
Okay, so it's not on the agenda, but right now, as of the committee terms will be, or the positions will be appointed on 6:30, or is it on 6:30 or by 6:30? Is Kathy or Eric, if you could comment on that?
It's by 6:30.
Okay, so they'll hold, they'll ask for people to submit their desire to continue, or any new people to apply to the city council for the committee. Is that correct?
Correct.
Okay. All right. So if you guys, if you want to continue on, be looking for that. Joanne, I'm sure will send that to you. I remember we had one committee member, he didn't realize he needed to reapply. So that'll be coming up in June of next year. So let's see, any public input? I don't think we have any public on here. Okay.
Uh-oh.
Anything else before we adjourn the meeting?
I just lost Zoom.
You're still there.
Okay.
Nothing from the city of St. Pete. Thank you, Mark.
It's good that it's at the end of the meeting that this is happening.
Let's see. I just need to have the date which we're adjourning to. And that is going to be
January 27th.
February 27th.
January
Okay.
27th.
Oh,
January
January
27th, yeah.
Got it. All right. So do I have a motion to adjourn the meeting to our next meeting on January 27th?
Is it 27 or 25? Because in the notes it says 25.
On a Monday.
I don't have a calendar in front of me. All
Oh,
right.
yeah, January 25th.
Monday.
All right, 25th.
Okay, 25th. Glad we straightened that out. That way we won't have to correct the minutes. Okay, do I have a motion for that? Al, I'm looking at you. You want to make
Yeah,
that
well, I'm
motion?
waiting for Art to second it. All right, I will make a motion to end the meeting. All right.
Do I have a second?
Second.
All in favor?
Aye.
Aye.
Great night.
Any opposed? All right, so moved. I appreciate everyone's attendance and all the work that you guys do for the city by being on this committee. And like I said, getting the investment policy right, I think is probably our most important job. And I appreciate all the input everyone has. So and Courtney, thank you so much for being on this call, and Eric too, and
Welcome.
Yeah.
taking us through it. So with that,
Well, yeah,
I'll
big